Hey, it's John Crypto, 127.17 for every ounce. There is no mistake. That's how much real silver costs in Shanghai right now. At the same time, the global benchmark for COMEX spot silver is having trouble staying at 107.94. That's an extra 17.8% charge. And this is the first thing you should know about the crime scene. In a working global market, this number shouldn't be there. Not 17%, not even 7%. Arbitrage is supposed to close gaps like this in just a few hours. Money comes in. The metal moves. Prices come together. The case is done. But that's not what's happening. This gap isn't getting any smaller. It's getting louder. This is where the lie starts. You can hear the same lazy script over and over again on the financial news. Silver has hit its peak. Speculative excess is going away. Retail mania is slowing down. They say that the changes in price on COMEX are proof. The volatility rises. The price of futures goes down. Red candles. Analysts nod seriously and say, "See, it's done." That's the reason. But here's the truth that they don't want you to know. People in New York are throwing away paper silver, but China is paying almost 20% more for real silver. Not exchange-traded funds, futures, or promises. You can hold metal. So let me ask you something that they won't ask on TV. Why is China so willing to pay too much for silver when it is at its highest point? That question alone ruins the story. This is not how tops look. People don't rush to buy tops. Tops don't make arbitrage windows so big that a cargo ship full of gold could fit through them. And now, here's the big news. You can't just call this a sentiment spike in demand. This is a forced paper liquidation happening at the same time as a real shortage. Two markets, two worlds. On one side, you have COMEX. COMEX is a machine that makes paper. There was a lot of futures volume and open interest piled up to the ceiling. Contracts were traded back and forth at breakneck speed, but no one meant to deliver them. When the price drops, there aren't suddenly millions of ounces there. Someone threw away paper, and paper never runs out. Want to sell 100 million ounces on COMEX? No problem. Just click the button. You don't need any silver. Now, how does that stack up against Shanghai? You can buy gold in person at the Shanghai Gold Exchange. There is no way to get out that doesn't involve cash. When you buy silver there, you get metal. The vault opens and bars come out. The stock goes down, and the supply really goes away. This premium is important for that reason. COMEX makes deals. Shanghai does business with metals. And right now, metal is yelling that the price of paper is a lie. This is where retail gets stuck. Volatility hits the COMEX and the price drops quickly. Headlines scream collapse, and retail traders go crazy. Stops get hit, and weak hands throw up positions. On social media, there are a lot of doom posts about the top being in. In the meantime, keep a close eye on how quickly physical premiums go up. The Shanghai premium rises to 117.8%. Even futures arbitrage stays wide, with SHFE contracts trading $4.52 more per ounce than COMEX after VAT adjustments. That's not noise, that neon sign means profit. Now put the pieces together. What happens when arbitrage gets this big? Metal goes from the west to the east, from markets that need a lot of paper to ones that need a lot of stuff. This is the snare. They lower the price of paper so that the smart money can buy the real deal. Retailers think risk when they see red candles. Smart people see red candles and think transfer of inventory. What about the banks? They really like this part. Selling paper makes you look weak. The media makes it stronger. Confidence breaks. All the while, the real market, which actually buys silver, is paying more and using up the supply. This isn't a coincidence. These price changes aren't random. This is how controlled markets keep shortages hidden. China doesn't trade strategic metals for fun. This is the country that uses the most silver. It makes solar panels, electric cars, and infrastructure for the grid. It also makes hardware for AI. Don't bet on that supply chain. You make it safe. Seeing China pay $127 for silver while the West says it's worth $108 shows that two different truths are coming together. One is on paper and the other is real. One of them is lying. This is the most dangerous part of the system, though. As long as this arbitrage window is open, paper sell-offs won't be able to finish the job. Every dip makes a hole, every smash pulls more metal to the east, and every topping headline speeds up the drain. The price movement looks crazy. But what's really going on? There is a methodical transfer going on right in front of our eyes. You won't believe what's going on in Western silver vaults if you think this price change is crazy. There is already blood on the floor in Western silver vaults. The COMEX registered inventory just fell apart while everyone was busy with fake topping stories and red candles. In late January, over the course of 7 trading days, about 26% of registered silver disappeared. Gone. Gone. There will be no press conference, no emergency headline, simply gone. Stop right there, because most people don't understand how crazy that is. There are 2 kinds of silver on COMEX, eligible and registered. Eligible silver is just metal that is kept in a vault. Someone owns it, but it's not for sale. It doesn't help the futures market at all. Are you registered? That's the real deal. That's the silver that actually backs up delivery contracts. That's the pool that keeps the paper game going. And in only 1 week, more than 25% of that pool ran out. They won't say this out loud, but metal doesn't go away that quickly unless someone is scared. There is no vault that bleeds by accident. People don't just leave bars unless delivery notices are flying or someone is front-running a shortage. Now connect this to what you saw in part 1. Shanghai is going crazy with a 17.8% premium. There are a lot of chances to make money, but Western delivery silver suddenly disappears. Is it just a coincidence? No. This is how things work. Now let's talk about leverage, because this is where the crime becomes clear. In the past, COMEX had 100 or more paper ounces for every real silver ounce. That means that for every real bar in a vault, there are hundreds of paper claims floating around like IOUs at a poker table. And here's the trick. You can sell as much as you want on futures markets. You don't need silver to sell it. You don't need stock. You don't even need to mean it. You only sell contracts. Prices go down. The story goes on. No delivery intent. Most impact. But Shanghai doesn't play along. The Shanghai Gold Exchange requires delivery. When you buy, the metal leaves the system. There is no rolling forever, and you can't get out of cash settlement. That's why prices go up there first. Reality hits faster. If the price of paper goes up in New York and the number of deliveries goes down, that's not a good sign for the market. You are seeing a false sense of security break down when things get tough. It's time to call out the bad guys. The COMEX banks are the usual suspects when prices look like they might go up. Their job is not to find prices, but to keep them stable. They will do anything to protect the paper benchmark, because if COMEX loses its power, the whole pricing system will fall apart. What do they do then? They throw away futures with a lot of force, even when there isn't much money. They break the price just enough to change the headlines and set off stops. JP Morgan and the Bullion Bank cartel, who have long been known as the biggest short-side players, know exactly how much paper it takes to scare the market. The goal isn't to make money on the short. The goal is to get more time, stop the momentum, and shake hands that aren't strong. Don't run right now. That's when the switch and bait happens. Be very careful with the order. First, use futures to bring down the cost of paper. Second, the news is full of top, bubble, and mania over. Third, retail sells out of fear. Fourth, and this is the quiet part, buyers come in and clean up. We've read this script before. Gold in 2020, same thing happened. The body disappeared, the premiums went through the roof, and the dealers went dark. In March 2020, the price of silver on paper dropped to $12, but it cost more than $20 in real life, if you could even find it. That was the first sign of trouble. What about FTX? It's the same scam, but with crypto. There are paper balances everywhere and unlimited leverage. People asked for delivery one day, but the metal wasn't there. The price on the screen was wrong. The truth won. Now go back even further. The paper markets were the first to crash. Assets were repriced. Liquidity evaporated. And then, after a few months, physical assets shot up once the dust settled. The delay wasn't for safety, it was manipulation. This is why the phrase is important. The end of the movie is always the same. The paper has cracks in it. Physical reaffirms value. The only thing to think about is when. This is where the system starts to get risky. This time, China is a new pressure point that wasn't there before. Back then, demand for goods was spread out. Now it's planned, industrial, and strategic. Silver doesn't go into ETFs when it leaves Western vaults anymore. It won't come back to exchanges. People are eating it. Solar panels don't sell silver again, and electric vehicles don't give it back. Grids don't recycle it when you ask them to. When you see 26% of registered inventory disappear in a week, don't think volatility. Think structural damage. The noose gets tighter with every bar that is taken away. The paper promise gets weaker with each delivery. Every trade that takes advantage of price differences takes power away from COMEX. This is the part that should keep bankers up at night. When the amount of registered inventory drops below a certain point, paper selling stops working. You can lower the price as much as you want, but if there is no metal left to deliver, trust dies right away. That brings us to the last twist. But this time, there's one big difference. The metal is going east and won't come back. And when that metal crosses the Pacific, it pretty much disappears from the Western system. The East versus West divide stops being a theory and starts to become deadly now that we're in the arbitrage pipeline. This is the number that matters, $4.52 more per ounce. That's the difference in prices between the Shanghai futures and the COMEX after taking out VAT and other things that affect prices. In normal markets, that kind of spread closes right away. People rush into trade, the metal moves, and the profit goes away. But this one is still available. Someone blocked the pipeline on purpose. That's why the deal is simple, very simple. You can get cheap silver in the West. Sell silver that costs a lot in the East. That price gap is like a vacuum. It pulls metal out of Western vaults and pushes it toward Asia. Every ounce that moves makes prices go up where delivery is real and down where prices are fake. What happened? The vaults in the West are empty. The stockpiles in the East are growing. And this isn't like moving things around in a warehouse or ETFs. It's not metal going around the same financial parking lot. Industries are using this silver and not giving it back. Now think of something that makes you feel bad. Who can take in that much silver without even noticing? That brings us to the secret buyer. China doesn't just buy things, it buys things. It's the world's biggest buyer of silver, accounting for about 30% of the world's demand, and that number is rising. Look at where it's going. Solar power uses up about 45% of all silver demand. China is the leader in making solar panels. Electric vehicles, a lot of silver. What is AI infrastructure? Grid growth, a lot of silver. Every megawatt, every data center, and every charging network quietly locks metal into hardware. This isn't hoarding for no reason. It's a lot of consumption. This is the most important thing that sets China apart from Wall Street. Silver is treated like a stock symbol on Wall Street. China thinks silver is a very important resource. Don't leave strategic metals to the casinos on Wall Street. Everything changed when Beijing acted. Silver was given a new name to make it a strategic resource. That's not a sign. That's just how it is. Export licenses are very important right now. Only 44 companies that the state has approved can send silver out of the country. To get one, you have to produce at least 80 tons of silver a year. That alone keeps smaller companies and independent arbitrageurs out of the market. There is a bottleneck on purpose. There are fewer exporters, more control, and less metal leaves China after it gets there. So even though the West still thinks silver is a risky investment, China has made it clear that this is part of the country's infrastructure. And the effect happens right away. Arbitrage is still possible, but it's harder, slower, and riskier. This means that the spread stays wider for longer, which makes it harder to find things outside of China. This isn't just the price discovery process breaking down. This is war in the supply chain. Zoom out. About 813 million ounces of gold are mined every year around the world. That's all. For the past 6 years, demand has been higher than supply. Since 2021, there has been a total shortfall of about 820 million ounces. Take a moment to think about it. We've used up everything that was made in a year and we're still going. There isn't a button for emergencies either. Mines don't open at night. New projects take 10 years to finish. The ore quality is getting worse. Prices are going up. Getting energy costs a lot of money. Getting water is getting harder. ESG rules make everything take longer. So when demand goes up or stocks run out, the supply doesn't change. It breaks. This is why paper suppression used to work. The extra stuff hid the cracks. That extra is no longer there. Now add money to this. Silver isn't just a metal used in industry. It's a metal that remembers money. For 5,000 years, it's been money. No one is responsible for it. It doesn't fail. It doesn't get printed. And China is fully aware of what it's doing. This isn't just a short-term price increase. It's about lowering your exposure to the dollar while locking in inputs for long-term success. If you're planning decades ahead, you don't want the Western paper markets that set the price of your energy transition to be based on a currency you don't control. You lock up the metal first. This is why the divide between East and West is so important. The West sets the price of silver by using stories and leverage. The East decides how much silver costs based on how much is needed and when it will be delivered. Two systems, one piece of metal. And when those systems go in different ways, one of them breaks. The uncomfortable truth is that the dollar-based pricing system only works when real goods and services follow paper signals. The illusion ends as soon as the real markets say no. And that's what you can see now. Silver is already breaking apart in its physical form. Premiums are the warning signs. Stress fractures are the problems that come up with arbitrage. Inventory drains are the damage to the building. This isn't about silver anymore. This is about who owns real things in a world where people owe money and make promises. When the price of real metals goes up, it shows something much bigger. The whole system based on debt. Because debt only lasts as long as people think it's cash. And right now that play is falling apart. The bomb under the table is the debt of the government. The US isn't just running deficits, they're getting worse and worse. Every year, trillions of dollars change hands. The tax base is being eaten alive by interest costs alone. More buyers, more leverage, and more faith are needed at every auction. Look to the east now. Japan, the country that tests financial denial, is losing control of its bond market. Yields that have been stuck for years are now going through policy ceilings. The Bank of Japan can either defend the peg by buying everything or let rates go up and blow up its own balance sheet. Neither option is good. Now put the pieces together. Leverage keeps the world together. Bonds keep banks safe. Banks use derivatives as collateral. Derivatives help the markets. The markets make debt okay. It's a closed loop, but one piece can slip. And here's the ugly truth that no one on TV will tell you. People have to still believe in promises made on paper for paper assets to work. That belief is being put to the test right now. Now we can talk about the Federal Reserve. The Federal Reserve always acts like it has choices, but it doesn't. It has a script that shows two paths every cycle. Letting the system fall apart is option 1. Default spread. Banks fail. Pensions go away. The government is a mess. Option 2 is to print cash, print promises, print backstops to make money off the mess. History has already answered this question every time. They make copies. People don't want to print, but they have to because the other option ends careers, governments, and empires. People say that printing is stable, but it's really a silent default. Your buying power pays for it. This is where silver comes in, like a forensic accountant. Banks aren't doing well these days. They can only stay in business as long as people trust them. Their assets are fake, but their debts are real. If people don't trust them, the math doesn't add up. Markets, the same thing. They are backed by derivatives that are so complicated that even the people who made them can't figure them out without blowing them up. There are trillions of dollars in notional exposure based on the idea that volatility stays low and liquidity always shows up. Now ask the tough question. What happens when a physical asset like money, technology, or energy doesn't follow the price on paper? That's not a deal, that's a claim. Silver is calling the bluff. When prices go up and down, the illusion is over. No more talking about it. It's over. This is why the suppression is so important. If silver is priced fairly, it means that every part of the system is too stretched. It means that the money is lying. The bonds are not priced correctly, and the balance sheets are not real. That's why the fight is so bad. Let's talk about the price now, because this isn't about hype, It's about mechanics. There is now a floor under silver that wasn't there before. Arbitrage makes sure that the West loses stock as long as Shanghai pays more for metal than COMEX says it's worth. Every time a paper rally falls apart, that floor gets stronger, not weaker. If the premium stays the same, two things must happen. The prices on COMEX either go up to match reality, or the vaults went to zero. There is not a door 3. This isn't a straight, smooth move. It never is. Prices don't go up. They gap. There are long periods of stress followed by violent changes. Think of snaps, not slopes. And when it does happen, no one will know. People who thought there was no limit to liquidity will find out too late. So here's the part that no one wants to hear, but everyone needs to. This isn't about getting a pump. This isn't about timing the top. This is about getting rid of counterparty risk. Banks fail when people stop trusting them. Brokers stop working when volatility rises. When there isn't enough metal, cash is used to settle paper claims. You don't need anyone's permission to own real things. It's important to keep your own things safe. It's important to have things that aren't in the banking system. Not because you're paranoid, but because history tends to repeat itself. Before it happens, every big reset seems crazy. After that, it makes sense. And this is the last warning. The empire dies when its money is fake. Not overnight, but all at once. Silver isn't going anywhere. It's not a guess. It isn't too much. It shows the truth. This isn't about getting rich quickly. It's about not fading away slowly. You can't make excuses when paper breaks. Brokers won't. Banks won't. No governments will. Do your own work. Inquire about the cost. Know the difference between promises and ownership. When this breaks, you can't do it again. You can only get receipts. Be alert and stay on your own.